Hi, everybody. My name is Craig Michaelson. Just quickly regarding me, I used to be with Invest Tools, TD Ameritrade for 15 years. I was a coach there, an educator, an instructor. I want to thank you for your consideration in my joining this tremendous team of instructors that you have here. Thank you, Darren, for helping me get connected with the Online Trading Academy. I really do appreciate that. Before I get started with the presentation, just a really quick disclaimer here. Obviously, I'm in a home office. I don't have a stage to work on, and I don't have an audience that I can utilize and create a human option chain and just interact with them in that fashion. So with the limited resources that I have available, hopefully this will be enjoyable for you. Please, if there are any concerns that you have after you've watched the presentation, let's talk about it. Let's overcome and resolve any concerns that you might have, okay? All right, so my presentation then today is going to be on the Greeks, specifically Delta. Now, don't run away quite yet. Don't run away. Any money manager, anybody managing a portfolio needs to understand the Greeks. If you're using options in your portfolio, we need to understand the Greeks. Options are a tremendous asset to a portfolio. We need to understand the basics of those options, and that does include the Greeks. I know that they can be confusing. Some of you say, hey, they're intimidating. Some of you maybe say that they're hard to understand. I get that. Raise your hands in the audience. How many of you feel like you've got a pretty good handle on the Greeks? There's always a small handful of you that are going to say, yeah, I've got it. And you know what that means to the rest of us? Listen, there's our examples. They got it. We can get it. And it'll help you out tremendously. You know, I was asked the question years ago, hey, Craig, do you use the Greeks? Do you spend much time with Delta or Vega or what have you? And you know my answer was, no, I don't spend much. I place little importance on the Greeks. I don't spend much time with the Greeks. Why would I say that? Because I understand that they are confusing. They're intimidating. They can be hard to understand. Okay, but we overcome. You know what a wise old Homer Simpson once said? He said, hey, kids, you tried your best and you failed miserably. So what's the lesson? Don't try. No, Homer, we don't want to do that. If we've tried options, if we've tried learning about the Greeks and we feel like we failed, we just get right back on that saddle and keep on plugging away until we understand it. And once we understand it, we're able to take better control. Okay? Here's a question. Why should I use options? Why should I learn about the Greeks? Well, what if I said to you, consider some of these Greeks. For example, the Delta. The Delta for a portfolio manager can actually help you to take control of your portfolio. The Delta can kind of help you become a better money manager. The Delta can help you control market risk. Don't you want to be more in control? The Delta literally can help us with that. The Delta also tells us as the market starts to move, how much our portfolio might benefit or lose with that as the market gets started, with that short-term movement. Then there's this gamma. And the gamma kind of is this future, giving us this future idea in terms of sense of if the market continues to go stronger than it is, more than just a couple of bucks here, how good or how bad is this going to be to my portfolio? Gamma helps us to recognize future risk. You guys have heard of theta, I'm sure. Helps us to recognize the kinds of gains or losses that we might experience just simply by holding on to contracts, owning them, shorting, going long or short even. How would you like to capitalize on the volatility that this market's been experiencing this year? We've got politicians helping to drive some volatility, geopolitical events driving some volatility. You know, fear out there causes inflated prices. The Vega, as one of the Greeks, will help to show you where you can take advantage and find opportunities in this volatile market. Or the Vega might actually help you to say, hey, look, you know what, let's stay away from this option because of the volatility. You know what else that Homer Simpson said one time? Homer Simpson said, if you really want something in life, you've got to work for it. So if we really want to use the option Greeks and options themselves as a money manager in our portfolio and understand that, we've got to work for it. You know, Homer said that right before he said, "Quiet, everybody, they're about to announce the lotto numbers." Some of you will get that a little bit later today, I'm sure. Let me share my screen with you, okay? I'm going to bring up just a quick slideshow on the delta so that we can kind of get a sense for what this delta, as one of the option Greeks, can actually do for us as a money manager, as a responsible money manager. So first of all, delta, when you take on a contract, an option contract, delta can be positive or negative to your portfolio, okay? When you buy and sell options, it's going to generate positive or negative deltas. Now, if your delta on your option happens to be positive, make a note of this, write it down and underline it. The benefit to you is when prices rise. If your delta is positive, the benefit is when prices rise. The delta might also be negative. The benefit then to you, if you have a negative delta on that option, is when prices fall. Okay, so that's important to write that down. Delta can also give us the equivalent shares that we might control. So in other words, think about stocks that you go out and buy. If you were to go out and buy one share of a stock, that one share equates to one delta. If you buy 25 shares of a company, that's the same as you having 25 deltas. Okay? What about shorting shares of a company? Yeah, if you short shares of a company, that creates a negative 100 shares to your portfolio. That's the equivalent, at that point in time anyway, of negative 100 deltas. Okay? Delta can also tell us how many dollars we might gain or lose given a $1 change in the underlying security. I'm going to show you how that works on the example in just a moment, but remember that. How many dollars we might gain or lose if the underlier moves up or down by $1. Okay? Now, delta can also give you an estimated probability that you'll be making money on a short or a sold option contract. We just use the inverse of the delta. Option deltas can be used literally, ladies and gentlemen, to help you control risk and market exposure, not just in individual stocks, but in an entire portfolio. This delta is literally a money manager's best tool, I think. Okay, so let me share my, let's now go to my desktop and the account, I should say. Before we get into the actual portfolio, I wanted to show you a chart, all right? The reason why I'm bringing up a chart, now this is just a chart of the SPY, the Exchange Traded Fund SPY, SPY. I'm just looking at the last 6 months. I'm not cherry picking times, I'm just saying, hey, what happened in this market? And then what we're going to do is we're looking at a technical tool, because as a portfolio manager, utilizing your technicals and understanding the Greeks is hypercritical. So what we're going to do real quickly is I'm going to highlight on the chart just a couple of time periods here, because that's all there was in the last 6 months, a couple of points that we might look at and say, hey, look, this technical tool helped me to recognize that weakness was creeping into the market. How do I know that? Let's look up here at the price activity. At the same time that our technical tool, which in this case is the stochastic, at the same time that the stochastic was showing signs of weakness in the market, price action was actually dropping. It was getting weaker. The second scenario here over on the right, same thing. During this time period, as you correlate the bottom area where the stochastic is to the price action up above, you'll notice that the stochastic somewhat informed us that there was market weakness. That's important. So as a money manager, as a portfolio manager, you're going to use your tools, your technical tools, to help you to recognize when you might need a hedge. Okay? Do we know how far down the market's going to drop when it starts to go? We didn't necessarily know how far it was going to go or the magnitude of the move, but a technical tool informed us that there was danger lurking. So what do we do as a money manager? We say, okay, look, here's a tool that I'm using telling me that things could potentially get bad. Let's go ahead and hedge the portfolio. Let's use deltas now in our options to figure out how this is going to help us out. So what we're going to do next is we're going to go over here to our portfolio. Now it's just a small one. For this illustration, I just grabbed a couple of stocks. Apple, John Deere, okay, right here. A few hundred shares of each. Total, if this was a cash account, we're talking about a $100,000 investment here, okay, between the two. $100,000 investment. All right, now, what we have to do is we either have to manage each individual stock and go look at their options and pick deltas to hedge the risk of each individual stock, or what we can do is what I've done here. I've taken my stock shares and I've converted them as though they were SPY shares. So it's kind of the equivalent as instead of me buying all these shares of these companies, I just went out and I purchased SPY. So now what the conversion is in terms of the deltas, it tells me if the general market, SPY, drops down or goes up, my delta will of course tell me how much I might expect to gain or lose. Now my delta in this case is just over 500. So the aggregate delta for my portfolio is about 500. Again, what does that delta tell us? If the price goes up or down by a buck, we can gain or lose by the delta. So if the market starts to fall by $1, there goes 500 bucks out the window. If it falls another dollar, there's another $500 out the window. Here's the simulation. I'm going to simulate that the market drops just in a few days' time, 10 bucks. What's the repercussions of that drop? Go over here to the right. Our portfolio just took a hit in less than a week, $10 drop in the market. I'm down $5,000. Okay? As a money manager, it's your responsibility to try to mitigate those losses. So what can I do? Buying puts and using the negative deltas associated with the puts can offset that loss. I don't necessarily want to go out there and sell all my shares. Okay, I'm willing to ride out some of the storm, but I sure would like to mitigate this loss. So what we're doing is we're going over here, and just for our example, about 39 days out, we're going to go to the put side, and I'm looking for this delta. I see this delta here is about 75. For a put, that's a negative 75 deltas. That's the $309 put. We're going to buy that. Now, if I've got 500 shares or deltas for my portfolio and I bring on board negative 75, they offset each other. So my 500 drops by 75 to 425. So think about that. You've just started to reduce some exposure to the market by utilizing this delta. Now, if the market drops, instead of you losing $500 per $1 drop in the market, it's $425. Okay, so let's buy that. Click the button here. I've taken on one contract. Now look at my loss. Instead of over $5,000 of loss, I'm only losing $4,200. You know what that translates to? In terms of losses, you just cut your losses by 15%. Now look, the option itself costs us about 10 bucks. It's about $1,000. On a $100,000 portfolio, my investment represents about 1% of my portfolio. So I said, hey, look, technical tools telling me there might be some weakness in the market. Let's go get some negative deltas to offset our portfolio deltas. Let's spend 1% of our portfolio to do it. And that 1% investment saved me 15% of the losses that I might have incurred. What if that's not enough? What if you said, I'd like to hedge more? I'll just buy 2 of those things. Now, instead of losing $5,000, I'm losing $3,400. $1,600. This is genius, folks. Think about it. I took 2% of my portfolio, created a hedge, and reduced my exposure and loss by 30%. I can buy more contracts if I want and reduce that loss even more. This is money in the bank. Think about it. This has real monetary value, $1,600 there. Here's the cool thing about this. Let's go back to the chart real quickly. In both scenarios this year, when the market dropped, it actually worked itself back up. Now look, your stochastic as a technical tool, you utilizing it as a manager, informed you that the market's likely to start heading back up. So you took action. What was that action? You decided to go ahead and get rid of your hedge because you don't need it anymore. So you locked in the profits. That offset loss, that $1,600 in savings, is actually a profit that you can make. We sell our put. The market in both scenarios worked itself back up. It was here when you started, the market dropped, and then it ended up coming right back to where it was. If you had not put that put on and hedged with the short deltas, you would have just watched the whole thing happen and you'd be right back to break even. But you, as a genius now money manager, have actually increased the market value of your entire portfolio. $1,600, that's like 1.6%. Your portfolio as the market went down and came back up, instead of being flat, which is what ordinarily should have happened, your portfolio is ahead now by 1.6%, the entire portfolio. Genius. You're the portfolio manager who protected the portfolio to the downside. You're the portfolio manager that actually increased profits on your portfolio just in that little dip. This is the kind of savings, ladies and gentlemen. The savings here alone can help cover the cost of this education. I look forward to speaking with you all later. Thank you so much for your time.